Ladies and gentlemen, when you woke up and checked your screen, what you saw was not a normal pullback. Silver was trading near $83, and then while most people were asleep, it collapsed into the low 70s in minutes. A 14% plunge does not just damage portfolios, it crushes confidence and pushes rational people toward the most dangerous action in market selling under maximum pressure. Listen carefully, because this matters. This move was not driven by fundamentals. It was not a sudden collapse in industrial demand, a mining shock, or retail investors taking profits. The timing alone exposes the truth. The drop occurred during the thinnest liquidity of the year, the ghost week, between Christmas and New Year, right around 2 a.m. Eastern Time. Who is actively trading silver at that hour? Not everyday investors, not long-term holders, and not pension managers on holiday. At that moment, the order book is a hollow hallway, and in a hollow hallway, even a small shove can sound like an earthquake. What likely happened is both simple and brutal. A heavily leveraged institutional player breached maintenance margin. In the institutional world, there are no warnings and no second chances. Control is handed to a risk engine, a cold algorithm with a single instruction: get out. It does not care about support levels, indicators, headlines, or emotion. It sells until the account is solvent again, completely price agnostic and relentless. In a healthy market, buyers absorb that flow. In a holiday vacuum, there are no buyers. The machine sells, price drops, liquidity disappears, and the cascade feeds on itself. That is why the chart looks like a cliff. The first lesson is this: before you react, ask whether a move is informational or mechanical. One changes reality. The other only exposes leverage. And if you sold in that moment, the market did not move you, it read you. Now that we know this was mechanical, the real question is why the drop was so extreme. Why didn't silver stop after $1 or $2? Why did it slice straight through the levels traders believed would hold? The answer lies in liquidity, or more precisely, in what happens when liquidity disappears at the worst possible moment. During normal market hours, prices feel stable because a thick wall of buy orders sits below the market. That bid stack absorbs selling pressure. But during Ghost Week, especially in the middle of the night, that wall is barely there. The market looks open, but structurally it is hollow. There are prices on the screen, yet very few real buyers committed underneath. When the forced liquidation began, the algorithm sold into that emptiness. The first wave pushed price down, searching for buyers. It found almost none. So it dropped the price again, not because value changed, but because the system was hunting for liquidity. Each dollar lower was an attempt to find anyone willing to take the other side. This is a liquidity cascade, and once it starts, it does not respond to logic, headlines, or sentiment. It stops only when real buyers finally appear. This is where most investors misread crashes. They assume red candles mean voluntary selling. In reality, much of this move came from sellers with no choice at all. They were not making decisions, they were being liquidated. That distinction is critical because it tells you whether demand truly vanished or simply stepped aside. By the time price reached the low 70s, the forced seller was nearly exhausted. The pressure eased not because fear disappeared, but because the weak hand was gone. And that leads to an uncomfortable truth. These events feel catastrophic, but they also cleanse the market. Leverage is flushed out, excess risk is removed, and what remains is a structure held by stronger hands. But this liquidation was only the first domino. What followed turned a bad move into a historic one. Just when it looked like the damage was done, the market crossed a line most investors never see. This is the point where a forced liquidation turns into a self-reinforcing collapse driven not by fear but by mathematics. To understand why the drop accelerated so violently, we need to talk about one word that quietly controls modern markets: gamma. Large banks and market makers constantly hedge option exposure. Under normal conditions, that hedging stabilizes price. But when volatility spikes and price falls too fast, those same hedges can flip from stabilizing to destructive. This is what traders call a gamma flip. It happens when dealers move from positive gamma to negative gamma, and when that happens, the rules of the game reverse. In negative gamma, every dollar decline forces dealers to sell more of the underlying asset to remain hedged. The market drops, the hedge demands more selling, and that selling pushes the market even lower. It creates a feedback loop that feeds on itself. No one is panicking. No one is making emotional decisions. The system is simply obeying equations. As silver broke through key levels, this gamma flip activated across the options market. Banks that were previously neutral suddenly became forced sellers alongside the liquidating institution. Instead of absorbing the fall, they amplified it. Price drop dealers sold to hedge, price dropped further, and the loop tightened. This is why the move went from sharp to violent in seconds. This phase is what turns a chart into a vertical line. From the outside, it looks like mass capitulation. Inside the system, it is pure automation. Risk models don't debate. They execute. And during Ghost Week, with almost no opposing flow, that execution had nothing to slow it down. What matters most is this gamma-driven selling is temporary by nature. It ends when volatility stabilizes and positions reset. Once the options books are rebalanced and the forced hedging stops, the pressure vanishes as quickly as it appeared. No long-term seller remains behind it. So when you see a move like this, you are not watching value disappear. You are watching risk controls collide in an illiquid environment. And once that collision burns itself out, the market is left asking a very different question. Why did it stop exactly where it did? That question matters more than anything else. If this was a true liquidity cascade, if forced liquidation and negative gamma were feeding on each other in an empty market, why didn't silver keep falling? Why did it stop precisely in the low 73 range and not continue to 60 or lower? In a pure vacuum, prices do not gently stabilize. They collapse until something intervenes. The answer is not sentiment, and it is not retail buying the dip in real time. At that hour, the system itself began to feel stress. Forced liquidation does not exist in isolation. Every contract has a counterparty. Every loss shows up somewhere else on the balance sheet. And eventually those losses concentrate in one place, the clearing infrastructure that guarantees the trades. As the liquidation intensified, the risk shifted from a single failed account to the integrity of the system that stands behind every futures transaction. When a large participant cannot meet obligations fast enough, the problem stops being about price and starts being about solvency. This is the moment when markets stop functioning as discovery mechanisms and start behaving like fault lines. At that point, bids did not appear because traders suddenly felt optimistic. They appeared because the plumbing of the financial system could not tolerate further strain. Liquidity, which had vanished minutes earlier, reemerged abruptly. That kind of response does not come from speculation. It comes from stabilization. This is why the low matters. It was not a technical level chosen by traders drawing lines on charts. It was a boundary defined by risk tolerance inside the system itself. Below that level, losses would have spread too far too fast, so the cascade was contained. Understanding this reframes the entire event. The market did not find fair value at 73. It found the point where disorder became unacceptable. And once that line was drawn, the character of the market changed again, shifting from collapse to containment. What happened next tells us who was really in control during those final moments of the drop and why this event was never just about silver. To understand who drew that line, you have to follow the stress signals, not the price chart. When silver slammed into the low 70s, the real alarm was not flashing on trading screens. It was flashing deep inside the overnight funding markets. This is where price volatility stops being a trading problem and becomes a systemic one. As the forced selling accelerated, counterparty risk exploded. Banks began to question whether the institutions on the other side of these trades could actually pay. When that doubt appears, lending freezes. Dealers pull bids, credit lines tighten, and the machinery that keeps markets liquid starts to seize. This is how localized damage threatens to spread into something much larger. At that moment, stability mattered more than profit. Liquidity did not return because someone believed silver was cheap. It returned because the system could not afford another hour of uncontrolled stress. Cash was injected, balance sheets were reinforced, and confidence was quietly restored behind the scenes. No announcements, no headlines, just action. This is a critical distinction most investors miss. The system did not intervene to save silver. It intervened to save itself. Silver was simply the pressure point where the weakness surfaced. Once liquidity reappeared, market makers were willing to quote prices again. The cascade lost fuel and the fall stopped. This is why the rebound that followed felt almost unnatural. One moment there were no bids, the next moment the floor was solid. That shift tells you the selling was never organic. It was a temporary malfunction that required a systemic response. And once the system stabilized, something remarkable became clear. While the paper market in the West was breaking under leverage, another market was sending a completely different signal, a signal that refused to confirm the crash at all. While the Western paper market was convulsing under forced liquidation and emergency stabilization, another market barely reacted. This divergence is not a footnote. It is the most important confirmation signal in the entire event. Because when price collapses for real reasons, it collapses everywhere. And that is not what happened. As New York was dealing with margin failures and risk engines, the Asian session told a completely different story. In Shanghai, silver traded as if the overnight chaos never occurred. Prices remained elevated, firm, and disconnected from the collapse seen on Western screens. This is not coincidence. It is structure. The Chinese market is driven primarily by physical demand, not by leveraged paper bets. Industrial buyers, manufacturers, and state-linked entities are not trading volatility. They are securing supply. When they see price weakness caused by mechanical failure elsewhere, they do not panic. They evaluate whether availability has changed. In this case, it had not. That difference in behavior exposed a widening gap between two worlds. On one side, a paper market dominated by leveraged derivatives and forced execution. On the other, a physical market governed by necessity and long-term planning. The price gap that opened between them was not noise. It was a diagnosis. A meaningful premium in one region, while another collapses, signals distortion, not balance. It tells you the selling pressure was localized, artificial, and temporary. Physical buyers were not validating the crash, they were ignoring it. This is how you separate signal from spectacle. When the asset itself continues to be valued elsewhere, the problem is not demand, it is the mechanism that set the price. And mechanisms can fail without changing reality. That realization shifts the entire narrative. The crash was not a verdict on silver. It was a stress test of the Western financial structure. And once you see that, the next question becomes unavoidable. If physical demand never blinked who was really selling and who was quietly buying into the chaos, once you strip away the headlines and look at the flow data, the answer becomes uncomfortable for the mainstream narrative. The selling did not come from small investors losing faith. It came from entities that had no choice. Meanwhile, the buying came from those who understood exactly what this moment represented. During the collapse, retail behavior moved in the opposite direction of what television commentators claimed. Instead of fleeing, long-term holders stepped in. Volume surged not on sell buttons, but on accumulation. This is a critical tell. Retail panic looks loud on charts, but it leaves fingerprints in the data. Those fingerprints were absent. The only aggressive sellers were institutional and automated. Large blocks hit the market in seconds, a signature that does not belong to human emotion. It belongs to forced execution. Once those blocks cleared, the selling pressure evaporated almost instantly. That is not how genuine bearish conviction behaves. Real bear markets grind. They do not finish in minutes. At the same time, physical inventories were quietly leaving the system. Metal was withdrawn, not deposited. That behavior contradicts every claim of collapsing demand. If silver were suddenly unwanted, it would be flowing back into storage. Instead, it was being removed and held elsewhere. That is accumulation, not distribution. This is where perception diverges from reality. Paper prices fell because leverage failed. Physical ownership increased because value did not. Those two things can happen simultaneously, and when they do, they create opportunity for those who can think beyond the screen. By the end of the event, the weak hands were gone. The forced sellers were finished. What remained were buyers who were not dependent on margin timing or overnight liquidity. That transition matters because markets behave very differently once selling becomes voluntary again. And now, with the chaos behind us, the calendar itself becomes the next catalyst. Because the ghost week vacuum is about to end, and when full participation returns, distorted prices rarely stay distorted for long. The timing of this event is not accidental, and neither is what comes next. Ghost Week created the vacuum that allowed this crash to occur, but that same vacuum also delayed the response from fully staffed institutional desks. Markets do not reset until participation returns, and that return is now directly ahead. When traders walk back into their offices after the holiday break, they do not see the emotional chaos of the crash. They see the numbers, they see the spread, they see an asset that was mechanically forced down in illiquid conditions while physical demand held firm elsewhere. To professional allocators, that is not a warning sign, it is a signal. Distortions created by forced selling tend to unwind quickly once normal liquidity returns. The reason is simple. The sellers are gone, the risk engines are quiet, the options books have been rebalanced. What remains is a price that no longer reflects stress but opportunity. And when opportunity appears at scale, capital responds. This is how rebounds surprise people. Not because they are mysterious, but because they are misunderstood. The same speed that made the drop feel violent can work in reverse when pressure is removed. When liquidity returns, bids do not reappear slowly. They snap back. This is why waiting for confirmation after events like this often means missing the move. By the time the chart looks safe again, price is already adjusted. Markets reward those who can identify structure before sentiment catches up. What matters now is not predicting the exact path higher, but recognizing that the conditions that created the crash are no longer present. The imbalance has shifted. And with the calendar flipping and participation returning, the focus moves from damage assessment to positioning. That brings us to the final questions every investor must answer for themselves. What lessons does this event actually teach? And how should you respond when the system shows you its weaknesses so clearly? Events like this are rare, but they are revealing. They strip markets down to their core mechanics and expose who is prepared and who is not. The biggest mistake investors make after a shock is treating it as noise instead of information. This was not random, it was diagnostic. The first lesson is structural. Leverage creates fragility. When markets are calm, leverage looks like intelligence. When stress appears, it turns into a liability that forces selling at the worst possible time. If you were not forced to act during this event, that alone places you in a stronger position than those who power. The second lesson is psychological. Screens lie when context is missing. A collapsing chart triggers fear because the brain assumes intent behind the move. But as you have seen, much of modern market behavior is not driven by belief. It is driven by automation. Understanding that difference is the key to maintaining discipline when others lose it. The third lesson is global. Price discovery does not belong to one exchange. When one market collapses while another holds firm, the truth lies in the divergence. Physical demand, inventory movement, and regional premiums often speak louder than headlines or candles. Finally, there is a lesson about patience. Mechanical dislocations resolve on their own timeline, not on your emotional one. The market does not reward those who react fastest. It rewards those who react correctly. That means identifying whether risk has increased or simply been transferred. This event transferred risk. It moved it from leveraged players to holders who can withstand volatility. That is not bearish. It is foundational. Markets built on stronger hands behave differently in the weeks and months that follow. With that understanding, the final chapter is not about fear or prediction. It is about strategy, how to think, how to position, and how to use moments like this not as threats, but as advantages. What happened overnight was not a warning to run away. It was a lesson in how modern markets really function and an opportunity disguised as chaos. When you step back and connect the sequence, the message becomes clear. A leveraged player failed. Risk engines executed without discretion. Liquidity vanished temporarily. The system intervened to stabilize itself. And through all of it, the underlying value of the asset never disappeared. The strategic takeaway is simple but powerful. Do not confuse forced selling with genuine weakness. When price is pushed by mechanics instead of conviction, it creates distortion. Distortion is where long-term opportunity lives. The investors who benefit are not the fastest, loudest, or most emotional. They are the ones who understand structure and remain solvent while others are processed. This event also reinforces the importance of positioning. Assets held without leverage behave very differently under stress than those tied to margin and derivatives. Volatility does not destroy value on its own. It transfers ownership. And in this case, ownership moved from fragile balance sheets to stronger ones. Looking forward, remember this moment the next time fear dominates the screen. Ask who is being forced to act and who is choosing to act. Ask whether liquidity is revealing reality or distorting it. These questions matter far more than predictions. Most importantly, stay engaged. Moments like this are where understanding compounds faster than capital. If this breakdown helped you see the market more clearly, make sure you are prepared for the next one. If you found value in this analysis, press 1 in the comments if you are still holding, or 2 if this changed how you see volatility. Subscribe to the channel for deeper market breakdowns like this. Share this video with someone who needs perspective, and stay sharp. The market doesn't reward panic. It rewards understanding.